Hello and welcome to episode 191 of the Money to the Masses podcast with your resident expert as always, Damien Fay and me, Andy Leakes. Damien, I can tell it's been a week since we've recorded a podcast. Well, 2 weeks since the listeners have had a podcast because I got the start wrong. I forgot to tell the listeners what episode number it is. Not that anyone really cares. Damien, how are you doing?
I'm good, Andy. And the good news for podcast listeners is that Andy and I have just wasted an hour prior to this podcast.
This is the problem.
Catching up. And we kind of overran, and so we're now starting the podcast. We won't be asking too much about what each other's been up to, other than I've been on holiday, because we already know. So, yeah, good. So I suppose we're going to be straight with the money stuff this week.
Yeah, that is the problem with us. I kind of missed it last week. I'm hoping the listeners missed it too in a way, because I'm a needy sort of a person. But yeah, I've missed you for the last 2 weeks. So we did have that hour catch up. And it was really good to catch up. So, Damien, you've been on holiday. Do you want to just give us a 30-second soundbite? How was your week? Did you have a nice time?
I had a fab time. It was good to go away with the family. It was all about the kids. One of those sort of places where there's reps. If you know the sort of people who go and entertain the children non-stop, who work 15 hours a day, who seem like they're on some form of drug to keep going. I'm sure they're not. It was fantastic. The kids loved it. And anybody who follows me on social media, go to our Twitter channel, because you will see a video that I put up there of something that happened to me. Well, I basically got dragged up on stage within about 3 hours of actually arriving on one of these events, and involved me having to do a pant wearing competition. I managed to get 10 pairs of pants on in about a minute. Anyway, go and have a look. So yeah, Andy, my my holiday was really good, and I'm raring to go. And we've got an exciting quarter coming up in terms of Money to the Masses, product development, and everything else. So, shall I hit you with the money stuff this week?
Hit me with the money stuff. What have we got coming up on this week's pod?
Well, this one is kind of it is directly influenced by some reader or listener feedback. Now, I often ask you guys what you want to hear about, and I had a request from, I can't remember who it was, for the life of me. I've lost it. I've been on holiday, forgive me. But who said they wanted something, it would be interesting to have one or two pieces around lifestyle, so life events really. And they were fairly young, they were in their 20s, and they suggested some ideas. For example, students. What happens if you go away to university? Advice for students and money. And so that's what I'm going to do this week. And I'm going to do the first piece. Is going to be 7 ways to get the most out of your money at university. Now, you may not be going to university, but I can guarantee if you're not, you probably know somebody who is. So you can share your wisdom with them, or indeed this podcast. I'm also going to talk about debt. Now, while I was away, there was the interesting news that Wonga imploded. I don't know if you saw that, Andy. It collapsed.
I did. Couldn't have happened to a nicer company.
Yeah, so I'm going to have a brief discussion about that and my own view on it. But leading on from that, I should say, is a nice link, because there's been some new credit card rules that have come in. And I want to reiterate what they are, explain to people what they are, and about paying off debt. And the last piece is some investing and finance records, and just a little bit of fun with a little bit of insight sprinkled in there.
Great stuff. So let's, I'll tell you what, why don't we start with the university piece, and specifically centred around money and how to look after your money going to university.
Yeah. Now, I remember when I went to university, it was actually more than 20 years ago, which is...
I was going to say, can you still remember?
I tell you, Andy, it was almost one of those moments. I had no issue with turning 40. It was when I was 38, I suddenly realised it had been 20 years since I'd been to university. There's a massive part of me that still thinks he is that 20 or 18-year-old lad that went to university. So... I know what it's like to obviously go to university, and it's a daunting place and about money, because realistically, when you're 18, you don't have a lot of experience of money. And I could list a load of money mistakes I made when I was 18, including taking out too much credit, which is one of the things that they love to do when you're 18, is to ply you with credit. But what I want to do is give some advice to people about what they can do or should do or look out for when they go to university. Now, some of it is common sense, but others are some tips they may find useful or might not be aware of. Now, the first thing is, when you go to university, or before you go, I should say, because we're recording this in the beginning part of September. Most universities won't go back for a number of weeks. You're going to need a bank account, and some people won't have bank accounts because they may not have done any banking because they were juveniles. So you need to get a bank account, a student bank account for your grants and all this sort of thing to go in, and also for you to live off. Now, a lot of banks and building societies will do student accounts, and these accounts come with all sorts of incentives and gifts. Now, the reality is that they are a kind of like a honey trap, really. So what they do, banks know that most people will bank with the bank they first start using for the most of their life. People don't change their bank, they change their spouses more often than they change their bank. So they give you these great incentives, including overdrafts or whatever it is, to get you in there because they know you're likely to stay with them and probably take out plenty of financial products, and in particular a mortgage with them, because most people will just go to their bank rather than go and seek independent advice. So that's why they do it. They don't do it because they like you. They do it because they think you're going to be rich one day. Anyway, that's the lecture over, but that's just telling you the reality. What you need to do is go and look beyond the incentives and the sort of headline grabbing deals or part of the account and focus on any rates, any fees, any charges. Now, if you go to moneysupermarket.com/current-accounts /student-bank-accounts. They do a comparison table of student bank accounts, and you can go on there and see the various differences and rates, etc. So you can compare them. You're better off doing that before you go, so you've got everything lined up. The next thing I would say is, if you're going to be a student, the one thing you're going to end up doing, I guarantee you're going to do a lot of it, is travel. And I remember when I was a student, and this existed back then, with the travel cards. Now, you can get travel cards, for example, the equivalent of like a young person's travel card for 16 to 25-year-olds. And you can save a third off of train fare. So when you do decide to head home, it will save you a small fortune. They cost £30 a year or £70 for 3 years, but you'll pretty much almost make that back in probably one journey. The other thing you could do is get a National Express card, so the coaches. It works in the same way. You get a third off of coach fares, but obviously coach fares are even cheaper than train fares anyway. Now that pass is £12.50 a year or £30 for 3 years. So get your discounted travel set up before you decide you'll need it. The other thing to do is the wonderful world of NUS discounts. Now, if you're part of if you go to university, you can become part of the National sort of Union of Students, the NUS, and get a card that proves you are a student. You get a number that's unique to you, and you can use that card with your picture on to get all sorts of discounts all over the place. Now, if you go to a university that's in a city, as my sibling did, then you're going to be, there'll be all loads of places. There'll be shops, there'll be pubs, there'll be clubs that will offer you discounts and student nights if you flash your card. Now, one bit of advice is, if you go somewhere and there isn't a discount, ask if there is, and you'll be surprised they probably do a discount even if they don't advertise it. Now, you may, before people who are thinking, oh, I'm going to jump forward, this isn't for me, I'm not a student, I'm going to let you in on a secret. Anybody could get a student discount, even if they're not technically a student. And this comes about, to become a student, to get an NUS card, to be classed as a student, you have to be registered on one of a certain number of courses, which is typically things like degree courses. But it is possible to register via something called the New Skills Academy, via Groupon. We all know what Groupon is, and get like a discounted course. And you will be classed as a student, and therefore could apply for a free NUS card, which you can then use to get discounts in shops all over the place. By registering for a course you have no interest in doing, and the course can cost as little as £12. Now, there is a course on there for a course in blogging, and it's some sort of remote course for £12. Effectively, you're paying £12 for a card that can save you thousands, and it's legitimate. People do it. I've seen it on plenty of money saving blogs championing the idea. Whether you could debate whether it's in the spirit of what the NUS is all about, but they allow you to do it, so it's all above board. Now, you can get a kind of a premium NUS card called NUS Extra if you pay £12. That gives you some slightly juicier discounts like Amazon Prime, and that kind of you get discounts on Amazon Prime, and that makes me smile because talking about when I was 18, the internet didn't actually quite exist at that point. So the idea of getting a discount on Amazon Prime is a whole world away from when I was at uni, probably like most listeners. You can use it online. Now, the way to do that is there's a website called myunidays.com, which you register on if you're a student, and you can get discounts by shopping online for brands such as Nike, Apple, ASOS. So there's some decent brands on there, and I'd never heard of this, obviously, because they didn't exist when I was around and being a student. So being a student can save you money online as well as offline. The fourth thing is, obviously, if you're going to need money, you're going to need an income, get a job. There are plenty of ways you can make money which don't include getting a part-time job. I remember people still do get part-time jobs in the student unions, but obviously there are ways to make money online rather than just offline these days that didn't exist previously. If you want some ideas on that, then go onto our website, moneytothemasses.com, and click on ways to make money. There's a drop down there. You'll see some ideas. I'm not a fan of matched betting. I know that seems to be popular. People think it's a very safe way of making money. I don't particularly like it. I think it's a route to gambling, and given that the devil makes work for idle hands, is that the phrase, Andy?
Yeah, I think so.
It's that if we've got too much time at university, and what really does is match betting, if you don't know, is where you pretty much use different offers from different bookies to make sure you can't lose. It'll be on football, there might be a good offer on Man City to win, and there may be a good offer on another one for Man City to lose, and you use those offers, bet with one and the other, and you pretty much can guarantee to make a small amount of money. If you keep doing that, you can make a decent income. The only thing is, they obviously then try and use all the tricks of marketing to get you to start using the online casinos and all that kind of stuff. So it's a slippery slope. I would really suggest you don't do it.
And also, while it is completely legal to do so, the bookies do reserve the rights to not serve you as a customer, if you like, and there are patterns that start to open up when you do this kind of match betting, and they're well within their rights to what the phrase is called gub your account, which means that basically you've been barred. And so over time you will find that it's difficult to make a decent income doing it, because if you do it right, and by that we mean not actually gambling and playing the offers one off against the other, then eventually you'll find it more and more difficult to make money, and you end up not, it's not successful in the end.
Yeah, I mean, that does, and you'll see people go, I've made 12 grand in a year doing it, and they're always the extreme, and those people who talk about that are the people who are basically making money from the bookies to get people to sign up to their bookie account. So therefore, that's where they really start to make their money. They did it probably once, and so I would discourage people to do it. I'm not a fan. I mean, everybody likes to have an odd flutter. That's just fun. But doing something like that, it's a slippery slope. And let's be honest, there was plenty of things to get addicted to when you're 18 years old and you go to university. And gambling is not one that I think you should really be too easy to.
And ironically, studying seems to be something that all students don't ever seem to find an addiction or an affliction towards.
Yeah, no, I remember, I mean, it's very mild. I took up smoking when I was a student, just basically because I was bored. And then it took me about another sort of 5 or 6 years to quit. Books. Now, one of the things you're going to have to do when you go to uni is buy textbooks, and they're expensive. Obviously, look at eBay, look at Amazon Marketplace. But one of the things you could do is go on obviously, Facebook. You will find that most universities will have some form of Facebook group where students will be on there discussing things. And what you can do is you can post and try and find somebody who's on your course or has previously done it, has the textbooks you need, who might want to flog them to you. And obviously it's a good way of, if you're a student, getting rid of previous textbooks. Budgeting is the thing that you're going to have to do the most at uni, and there are plenty of apps that didn't exist. I mean, smartphones weren't around previously, but now you've got things like Yolt, Y-O-L-T, that can tie up to your bank account and see how you're spending money. It will probably produce a nice pie chart that just says alcohol, but you may find some benefit in trying to work out where your money comes in and out. Or Spending Tracker, which is another app. But basically, you need to start trying to learn to budget. Now, if you want to have a bit more about that, if you go and type in the words big picture budgeting into Money to the Masses, it's an idea that I came up with to help people budget. And it's really by having multiple accounts that deal with smaller parts. So your rent would be in one account, your money to get drunk on would be in another account, your money for food would be in another account, so you know where you are. It explains it on there very simply, but what you're doing is you're making silos, divvying your money up so you don't spend all your grants and loans on the frivolous stuff, but you make sure you've got some money that you can buy those baked beans with that you're going to live off. The final thing is insurance. Now, when you go to university, you're going to take your Xbox and all these things probably, and mobile phones to university with you because you can't live without all those gadgets that you've grown accustomed to over the years. But the thing is that you need to make sure they're insured, because according to, I think it was Direct Line who did some research on the topic, 1 in 4 students become the victim of crime. And in the last 3 years, about £25 million worth of goods have been stolen from students at university. So if you're not insured and your stuff gets stolen, obviously you've lost out. You're not going to be able to replace them. So ideally, obviously, that would mean that you need to go and pay to have insurance. But you can get insured without having to spend any money. And now this is one for parents out there, is to look into, you could extend your own home insurance typically to be able to cover your child's possessions while they're away. So have a look at that, whether you can and what can be covered before they go away, to see if you can actually help them out and extend your own home insurance to cover their stuff, which they're inevitably going to lose or break anyway while they're away. So there you go. 7 tips to make your money go that bit further when you're at university. Before we move on, Andy, I just wanted to quickly mention 80/20 Investor. Now, 80/20 Investor is my DIY investment service. Do go and check it out. I empower and teach people how to invest their own money. The service provides data-driven fund tables. The data is driven by my own unique 80/20 Investor algorithm, which I created. You also get stop-loss alerts, you get research articles and insights, you get market commentaries, monthly commentaries, and DIY investment lessons, but you also get access to my £50,000 portfolio, which is a portfolio of my own money, which I run live on the site for members to see, and it shows people how I use the service to maximise my returns. And in the first 2 years of doing so, I turned £50,000 into £59,500, which is a 19% return, beating investment managers, professional fund managers, financial advisors, investment banks, passive trackers in the market. So everybody can have a free 30-day trial of 80/20 Investor, and you can claim that by going to moneytothemasses.com and going and clicking on the 80/20 Investor hyperlink at the top of the page. So go and try the service. Let me know what you think of it, and I know from the feedback that you're going to love it. But for now, on with the show.
Okay, Damien, so Wonga hit the headlines recently. They've obviously gone into administration, and they're having, well, the UK arm certainly has had issues. And so we're going to talk about debt and Wonga specifically. What do we got?
Well, the thing, I thought I'd just chuck out my 2 pence worth about Wonga, because people seem to be debating whether they thought it was a good or bad thing. And so, first of all, it's a bad thing for the people who obviously work there, because you have to realise that the people who work for companies aren't the bad people, and it's one of the things I have about the city. People will go about the people in the city do this and this, and as if the ordinary people who work for banks, etc., are bad people. No, they're not. They're decent people doing their job, and I feel sorry for those people because it's going to impact them financially. So we set that aside.
Agreed.
But as a fundamental for consumers, Wonga going bust was only really a positive. Now, the reason that I say that is because one of the things that we often hear is that if it wasn't for Wonga and other payday lenders, then people would go to loan sharks and be getting these sort of desperate loans to make ends meet, and would be getting themselves into all sorts of strife. Well, given that these payday lenders charge percentage rates that were into the thousands of % APR a year, what happened is obviously they brought in a cap on the amount they could charge, and slowly over time this started to impact their business models. Then a load of complaints came in, and they were having to, for example, Wonga had to write off over £220 million of debt, which they actually issued to 330,000 customers, I think it was back in 2014, who couldn't afford to pay that debt. And so it's huge sums, but what the reality is, there's been little evidence that I've seen, or no evidence in fact really, to say there's been a large scale reduction in people using loan sharks by the fact that payday lenders existed, or the fact that now that payday lenders have had to, or people like Wonga will disappear, that people are now going to loan sharks. Of course there will be there'll be anecdotal stuff going on, but the reality is that
when you say loan sharks, Damien, define that for us, just in case. I mean, people hear the phrase bandied around. What do you mean when you say a loan shark?
Well, I suppose you can mean, like people say, any form of doorstep lending. So people who may be who would be unregulated, who will be lending them money, who will be charging them a fortune, that sort of stuff. So what we would really think of people who would probably you're borrowing money off in a slightly under the radar kind of operation that people get desperate to, have to seek. Now that's always going to happen, unfortunately. But the thing is with Wonga and a lot of the payday industry was that it was they pretty much used technology to make it so easy to acquire debt that they created a demand for a product that didn't really exist, if that makes sense. So there were people who were already out there who required like sort of short-term borrowing, but they made it so easy to be able to acquire that money that people were using the product the payday lending, no one ever knew what a payday lender was. It didn't exist. So they made it so you could go on there with a nice slidey buttons and click a button. Next minute money would drop into your account. So people were using it. I mean, I remember one time talking to a guy that a brother worked. Well, I was actually, I didn't talk to him personally because I wouldn't have said it to his face. But my brother said about a guy he knew who was using a payday lender. And he used payday lenders. He didn't have any problems with debt or anything like that. He just wanted to go out for a beer and he needed some money to go out that day. And he said, I just use this one guy. It's really easy. And so he just borrowed some money and just pay it back the next almost days later when he got paid. So he could go out. It was that easy. That's how he was using it as a kind of cash flow thing. And I said to my brother, he does know that's just wrecking his credit file, doesn't he? Because the thing is, if you have a payday lender on your credit file, it pretty much does destroy or hamper any chances of you getting a mortgage if you're going to want one in the near future until it drops off your record. Because it basically says to them that the lender looks at you and think you're high risk, you're desperate, you're basically barely making ends meet. And if you're resorting to high charged short-term loans, you're not going to be able to pay back a mortgage. And so people like that were starting to use those services who wouldn't have even gone looking for a loan. And they were also using Wonga, and people like that were giving loans to people who shouldn't really been given loans. They couldn't afford to pay it back. So it was a whole industry that really blew up, that there wasn't quite the need, and technology facilitated it and made it so slick and easy that it kind of got out of, I think, a bit out of control personally. So we had, and the fact there were so many claims that were being allowed meant that, well, it's kind of evidence that, and that's what ultimately killed Wonga, was the number of complaints. Now, of course, there'll be people listening to this who may have had Wonga loans, no problem with that. Some people might have needed to or want to, but what does that mean for people who have Wonga loans? Now, if they've gone into administration, what happens? You still have to pay that loan because you still owe the company that's going to take it over. The administrators will basically try and run the business and sort of dismantle it. So you have to still keep paying that. So make sure you do. What will happen is, if there were lots of people who had a claim going through that were being against Wonga for, like I said, for maybe they felt they were missold or whatever, they were actually going to get some money back from the company. Now they've gone bust. That's kind of on hold now. You just joined the list of creditors, the people who are owed money by Wonga, and that's going to be a long list, and you may never see any money back. And obviously there were people who were probably going to put in claims against Wonga. That's now you can't. That's done. So it's gone. The Ombudsman has confirmed that you can't now put a claim against Wonga for a loan that you were perhaps somehow missold or whatever it was. That's done. So it's an unfortunate position. It's a bad story for debt in some ways because Wonga existed. Good news that they've kind of gone out of business. But what will happen? Will somebody else come and fill the void? We'll have to wait and see. My opinion is that what really happened is that there was a lot of probably governmental support for people who needed that kind of help and loans. That kind of has all been pulled back. So there were people like Wonga fill a void that is there, where perhaps other sort of official, like the government, should have somehow stepped in. Now, there are things like credit unions that are out there, but the problem is, the reason people don't know they exist is they don't have the marketing budgets of the likes of Wonga. Wonga had huge marketing budgets that could go out there and just blitz it and everyone knew who they were. It just shows you the power of marketing and money. So, it's good that it's gone. Now, on a more positive note, trying to help people who deal with credit, there were new rules that came in regarding credit cards. So we've moved away from payday loans, we're now onto credit cards. Now, back in March this year, there was announced, the FCA said that there were going to be new rules came in about helping people with persistent debt, that the credit card companies would be obliged, there were rules coming in to make them help people with persistent debt. And the reason I bring it up now, and we're focusing on it this week, is that although the rules came in March, companies only had they had leeway until the beginning of September 2018 to actually obliged to comply. So now they have to comply with these new rules. So what are the rules so people know? Now, persistent debt is defined as if a customer has paid more in charges and interest in 18 months than they have repaid on the debt that's on the credit card. So you can see, realistically, you're not making any headway on the debt. And so if that happens and you start, it may be the person's only deciding to pay the minimums or whatever it is, and they're not really clearing this debt, then now the credit card company has to contact that person and prompt them to change their repayment plan, or say to the customer, if you don't change the plan, we can suspend your card. Now, after that point, by 27 months, they then can have to send them another reminder, say, like, come on, you're meant to be trying to pay this back. After 36 months, this is starting to get a bit ridiculous, to be honest. It's going on and on. Nothing really materially happens. But at the 36-month point, the lender must now offer a reasonable way to repay the debt. And if they can't, the FCA now say the firm must show, it's called forbearance, which is basically an element of patience with the borrower, and may have to reduce charges, waive or cancel interest or fees or charges. So they then have to start actually making some form of allowance to help this person repay the debt, which is a big positive for consumers. So it means that it's trying to stop them forever. You just stop this snowball of debt. We'll have to see how it actually pans out in the long run, but it is a positive for consumers. But the message really is, aside from these rules, that you obviously need to pay more than the minimum. Now, anybody who's listened to this podcast or seen the videos I did last year, We Need to Talk About Money, look at that hashtag on social media. You'll find the videos. One of the key ones on there was about how you can repay debt far, far quicker. It took the average debt repayment time from something like 29 years down to about 7, I think it was. If you just took the minimum payment you are paying now and ring up your credit card company and say, I want to keep it fixed. So if your minimum payment is £40 a month, what happens as you pay your debt back, that minimum amount starts to reduce because it's normally a percentage of the outstanding debt. So it's one of those things you never quite get to the end, so it lasts forever. If you said to them, I want to pay £40 forever, then £40 would be coming off. And as your debt starts to reduce, the amount you would pay accelerates. Does that make sense?
Indeed.
And so what ends up happening, you end up clearing it without having to pay any more, rather than your repayments going £40 a month to 39 to 38 over time. They stick at 40 and you'll clear the debt in a fraction of the time. So if you learn anything from today, ring your credit card company up, assuming you're repaying the minimum now already, comfortably. If you don't want to raise it, tell them to fix it. One thing I don't like about the new rules, there's a voluntary part of these rules. It's regarding the rising of your credit limit. You know, when the credit card company comes along and then suddenly goes, oh, good news, Mr. Leaks, we're going to increase your credit card limit. And I don't
It's
know...
happened in the last couple of months to me, to a credit card I haven't had for years. And just out of the blue, I've received a letter to say that I've got the most ridiculous amount of credit now available. I think it's something like £14,000.
Yeah.
That they've sent a letter to me and said, you know, you can use this 0% for blah, blah, blah. It's crazy. Just really irresponsible, I think. I didn't ask for it, didn't want it.
Yeah.
I just don't get it.
And that sort of thing is a bit of a bugbear of mine. And I remember over years having arguments with credit card companies saying, why did you do it? I don't want you to increase it. Ringing them up saying, can you reduce it? And they're going, well, that means we might not be able to increase it in the future. And you're like, well, good. But but then it still happens again. And I always remember once having a credit card company, I said I never want it to increase. I just want to have a £500 limit on it. And which might seem bizarre because it was one that I just used for online transactions. And the idea being at the time, I thought, well, do you know what? If anybody steals this credit card details, it's only got £500 limit. Now,
and also you're protected as well, aren't you?
Yeah, and
by using a credit card, you get the extra consumer protection.
But the reality is that these days that people do buy and sell credit card details online, even if you've not even used your card online, because they now hack and breach, as we talked about a couple of weeks ago. They can hack and breach systems and steal your details if you've even never used the credit card. So it wouldn't protect you against that. So anyway, it's just a sort of an aside. But I think that should become compulsory. But that's the good and the bad and the ugly of the debt world. Now, last piece. Investing and finance records. It's just a bit of fun, really. It was a piece that was done. Who was it by? One of the platforms. I think it was Hargreaves Lansdown. What they do is companies send out press releases and they come up with some wacky, weird thing, and then they try and tenuously get people to talk about it. Which actually this week they've succeeded. It would appear, because I'm talking about it. But actually, it was quite an interesting one. They talked about some of the weird records that have been out there in the latest edition of the Guinness Book of Records. So it's worth name checking them since they've gone to the hassle of actually putting them together. Now, financial records, Andy, are you ready?
I'm ready.
Inflation. Now, you may think inflation in the UK may be 2%, 2.6 or whatever it is now is a bit high. Now, the inflation record is held by Venezuela, which was hit in August this year, where they had an inflation rate of 60,000%. The highest inflation rate in the world. Second position was taken by Iran at 191%. So,
Damien, sorry, I think you made a mistake there. You said 60,000%.
I know. I mean, I'm not laughing because that is obviously a hideous position to be in if you're in Venezuela. But just the number is just mind-boggling. But yes, 60,000%. Argentina currently has the highest interest rate in the world at 60%. Now, a bit of insight why that happens, because if they're trying to defend their currency, which is going through the floor, they will try to do that by possibly raising interest rates. Now, do you remember it's a bit like if a bank raised the interest rate on its bank account, demand and everything will cause people money to flow into it. Kind of the same with currencies. If you increase the interest rate, then demand for that currency should make people want to buy it. Speculators, traders, investors, whoever, you name them, and it should help buoy the currency. That's why their currency is so, their interest rate is so high. 60% is incredible. By comparison, ours is at the moment less than 1%, 0.75%. Who's got the lowest? Switzerland, minus 0.75%. So that means that if you put your money with the Swiss central bank, you would actually have to pay them to look after your money. Crazy situation. But that is the world we live in post the financial crisis, where we have distorted economics because of central banks. The highest personal income tax rate in the world is in Aruba, 58.95%. Singapore is the most expensive city in the world to live in, followed by Paris and then Zurich. The highest returning fund available to UK investors over the last 20 years is a fund called Marlborough Special Situations Fund, which has increased by 3,493% in that time, which people might go, wow. But again, a bit of insight into that. That is a smaller companies fund. Now, if people remember, there are 3 investment strategies that have been proven to make money over time: momentum, value investing, and smaller companies investing. And smaller companies investing means if you invest in small companies that eventually become big companies, and that means that when you bought in early, the share price will rocket when they become the next big thing, Facebook, you name it, whatever it is, and you make a killing. Now, obviously that fund specialises in doing that, and over time it was always going to be probably a smaller companies fund that would have topped that chart. So that is what it's all about. The manager's obviously done well, but it's about investing in small caps over an extended period of time. And interestingly, if you go back 20 years in fund management world, there aren't that many funds that existed. So the comparison, if you may think, oh, there's 2,000 funds out there today. If you've gone back 20 years, there's a fraction of that. So it wouldn't have been a big list they picked from. Now, the best performing share in the UK over the last 20 years is JD Sports.
Really?
Which has gone up 12,846%. So perhaps Mike Ashley does know what he's doing after all, even if he doesn't know much about running a football club. The biggest one day ever drop in the FTSE All Share was in Black Monday in 20th of October 1987 when it fell 11.3%. The reason why these are interesting stats because if it happened once, it can happen again. The biggest ever one-day rise was 9%, which happened in March 1968. But what's interesting, if you have a fall, if something falls 50%, let's say, then it's got to rise 100% to get back to where it was. So it just shows you the disparity between falls and rises. And one of the last ones, which is interesting, Bitcoin suffered its largest one-day fall against the dollar, not in the last year, but in 2013, when it fell 49% in one day. But obviously, the bigger story was when the media was looking at it, was a 22% fall in one day this year. So it just shows you when the media are interested in the story, it gets a bigger headline. And it saw its biggest gain in November 2013 when it rose 62%. Now, interestingly, on Twitter, which is a final thought for today, I saw an interesting tweet by, I want to name check him, I think he's got a podcast. Yes, it's a chap called Ben Carlson who runs he runs a podcast, I think, called A Wealth of Common Sense. Anyway, tweeted something fairly interesting. He said that if you bought Bitcoin after Thanksgiving, so this year that would have been a loss of 30%. If you'd bought it after Christmas this year, you'd have been down 50% because obviously Bitcoin has sort of tumbled. It went from up nearly 20,000 down to about 6,000 now. At the peak to now where it is, you have lost 65%. But if you'd bought Bitcoin at the start of 2017, you'd be up 630%. And he makes the comment is that, as with all investments, if you just change the time frame, you can win any argument. So Bitcoin has officially been pretty much a bubble by the definitions. I think a bubble is if it falls by about 40%, it's burst. So a bubble has burst in the Bitcoin world. But there you go. Some interesting facts and figures around the world. But what I like about them is it just highlights the extremes that you can get. And I know comparing Venezuela's inflation rates, etc., to ours is obviously not going to be a direct comparison. But for people who take out mortgages, do look back in history. There'll be people listening to this podcast who say, I remember interest rates at 10%, etc., in the sort of late 80s, early 90s. I think the problem is we get used to a world that's been distorted with low volatility, incredibly low interest rates because of the financial crisis. So we do need to remember there is a world that happened before, and we do get extremes, even if we try and discount them. There, Andy, I'm done. I kind of overran this week. I apologise, but do you know what? That's what happens when you have a week off. You get a bit overexcited.
That's all right. You had a lot to get off your chest, clearly. If you do want to get in touch with Damien, you can do so in the usual ways. Twitter's a really good place to drop a line. It is at Money to the Masses with a number 2. Of course, you can get on to Damien as well via email, damien@moneytothemasses.com. And if you'd really like to, if you've missed us the last couple of weeks and you'd like us to produce more content and reach more people, then please do leave us a review. Pop onto iTunes and give us a lovely glowing 5-star review. We'd really appreciate that. Damien, anything else?
No, that's it, Andy. You've done everything. Until next week.
Until next week.
Don't forget to claim your free copy of Damien's best-selling book, The 30-Day Money Plan. Sort your finances in just 5 minutes a day, worth $4.99. Just go to moneytothemasses.com/podcast to find out how.